Our final seminar this morning is hosted by title sponsor Jones and Roth CPAs and business advisor. Speaking today, we have Senior Manager Jordan Dawley. Jordan is a native of Bend. His specialized areas of expertise include strategic tax planning for individual and family clients, as well as business tax and advisory across a wide variety of industries. He is an active coach and advisor, working closely with his clients to achieve short and long-term goals. Jordan serves as a key member of the firm's healthcare and dental teams and is the audit chair of their local chapter of the Risk Management Association. He graduated from the University of Oregon with bachelor's degrees in accounting and economics. Welcome, Jordan Dawley.
Check. Hey, we're here. All right. Hey, good to see y'all. Thanks for being here. It's just me up here. Okay. So there's no bounce back and forth between me and other colleagues. So appreciate you bearing with me here. And I got to say, Shannon, beautiful place, of course. I'm sure many of you have been here before. I remember watching movies with my kid here. Great venue. But for tax discussion, dark room, couches, right before lunch, I don't know that they set me up the best for this, so appreciate you being engaged. I will take questions as you have them, so don't be afraid to raise a hand, and I will repeat them best I can, Shannon, for y'all there. One of my favorite things about this conference is there seems to be this like energy of discovery, new ideas, fresh perspectives. It's really exciting to see that. And when I was preparing last night, I actually realized I have a hidden talent myself, which I'm not going to spin plates or something. That's not what this is. But I realized I might have a future in stock photo modeling, okay? So I just realized my photo up there, and I'm pretty sure the prompt was a CPA walk down a hallway looking at a piece of paper, and I think I hit it pretty good. So there's that. So, hey, you never know what you might find out later in life. All right, so hey, today we're going to talk about a couple important things in the startup environment: business formation, tax considerations of it, initial accounting method elections and the impact they may have on you, some costs of starting business, intellectual property considerations, and again, like I said, let's ask questions, right? That's why we're here outside of office hours, which are tomorrow. A little plug for you there, Shannon. All right, Perkins Coie, which before I get going into the disclaimer, which I know they'd be proud of me for, just thank you for going through the complexity of stock options, right, and their taxation. And I can affirm his comment that, yes, it is one of the more complex sections of tax law. So thank you for going through that. Really appreciate that. But here, of course, my information, this is intended to be generic. It's not suited to your specific circumstance. So please consult with your CPA to make sure it does fit what you need, okay? All right, so let's talk about types of legal entities and what might make sense for your business when you're getting going here. The 5 main types we're going to talk about is sole proprietorships, right, also known as a disregarded entity, general partnerships, corporations, S corporations, and then LLCs in general, okay? All right, so let's kick it off with sole proprietorships. And these slides are just revolutionary in terms of their size. I'm going to pivot over here for just a minute. So sole proprietorships, right? This is ideal for just a simple business. We want to think about kind of like the long-term potential outcome of a company when you're forming. Very early stage ideas, it's okay to start in a sole proprietorship type of operation, right? Because there's no legal structure required for setup, okay? By rule, there's only one owner, right? So once you have more than one owner, you have other decisions you'll need to make on that front. Tax reporting is actually really simple. It goes straight onto Schedule C. Some downside of that is all your profit is subject to self-employment tax in addition to income tax, right? So simple reporting, simple structure, but also maybe less ideal tax treatment depending on what you got going on. And also not ideal is there's no limited liability, right? There's no formation of a legal entity protection of your assets. So, presumably someone could sue you for your personally held assets if there's an issue with the business, okay? All right, again, very similar flavor here, other than we got general partnerships. We have at least one other owner, right? At least 2 owners to be a partnership. Again, no legal formation is necessary. We file that on a partnership tax return. This is known as one of the pass-through entities, right? An S corporation, a partnership is known as a pass-through entity. That means this entity itself does not pay income tax. Instead, it passes through to the owners on the K-1, and you pick up the income tax on your tax return, okay? So important thing to note there. This setup as well, no legal formation required, which also means no limited liability, which, again, as we talked about, is maybe not ideal in your circumstance. And likewise, income that comes out on that K-1 from a partnership is also subject to the self-employment tax, okay? Which, again, that adds up fast. All right, Perkins Coie talked about C Corps, their attractiveness for angel investors. We're going to kind of compare and contrast later kind of considerations for tax, legal, and angel investor considerations. But some of the main reasons for that is a C Corp is its own entity for tax purposes. It pays its own income tax, right? So that's one of the key reasons that that's beneficial. And what I mean by that is if you have profits of a startup that maybe is retained for development and continued growth, there's no income tax impact to the owners, right? Because they didn't get any money via dividends. Stays all in the company. It's potentially taxed all in the company. Whereas an S Corp or a partnership, you're taxed on the income whether or not you distribute it, right? And so there's some silent investors who have no intention of taking early dividends that would be taxed as if they did. That's one of the key reasons that it's not ideal. All right. There's also double taxation, which I wouldn't want to be double taxed, right? There's certain instances that this might make some sense, of course, but it's key to note why this happens. And specifically, like I mentioned, C Corp's taxed on its profits. Dividends paid out to owners are taxed by the owners as dividends. And then importantly, the dividends do not reduce profit, right? So that's the double taxation that occurs, okay? All right, let's move on here. Oh yeah, reasonable compensation is very important, right? You provide services. You should take compensation commensurate with the services you provide. Actually, Perkins Coie made a good point relative to equity comp. You cannot just be compensated by equity compensation. So there should be some level of reasonable compensation coming out of the C Corp to yourself. Liability, we love to protect ourselves from liability. It's limited to the corporation as long as you meet corporate formalities, right? The board meetings, meeting minutes, those type of things on an annual basis, okay? The drawback of a C Corp, it's generally for that double taxation reason, it's generally not the most beneficial for closely held businesses, right? Because any money coming out is going to be taxed in some way in the form of profits or those dividends, wages, or otherwise, okay? Let's move on to S Corp, right? This is a popular one. I'd say probably 70% of the time that I get a call from a client that is starting a business or maybe has already started, I get really two questions is, do I need an LLC and should I be an S Corp, right? And the answer is, LLC is not a bad idea, of course, for legal protection, but it doesn't tell us how you're going to be taxed, right? Absent a tax election, depending on your ownership structure, an LLC can be taxed in a variety of ways. And I feel like, I don't know if it's TikTok or AI, which I wish I had the confidence of AI, by the way, right? You get questions, the answers come out with such confidence. Even if they're wrong, I'm like, this is fantastic. But oftentimes they're wrong, right? And so this has been really popular on the S Corp front, right? Is I hear I can do this. One of the big reasons people see it, the initial consideration is there's no self-employment tax on your net profit. So the first consideration most people have is, well, gosh, if I'm a partnership, I'm going to pay 15.3% self-employment tax. If I become an S Corp, I don't pay that. I'm going to save 15.3%. It's a simple solution, right? Unfortunately, same as a C Corp, an S Corp has a rule that you have to pay yourself, commensurate with the services you provide the company, a reasonable salary, right? And in this case, you're both the employee and the employer, so you're paying both sides of payroll tax, and that adds up to 12.9%, right, in payroll taxes. So quickly, depending on the salary you're paying yourself, that 15% perceived benefit of making the selection has gone down to at least 2%, 3%. It's usually somewhere in the range of 5 to 7% if you're electing in the right period and you have the appropriate level of profits to do so, right? So little nuance there to kind of understand why you may or may not become an S Corp. There's restrictions as well on ownership, right? Only 100 owners can be there in an S Corp, okay? And it can be no foreign owners, right? So important limitations there. All right, same thing on the, liability front. Corporate formalities recognized. We can keep the liability within the company. Oh, I jumped the gun on the reasonable salary, but I think we sufficiently covered that. All right, LLC, we talked about this a little bit, right? An LLC is a legal construct, right? It's a liability protection under state statute. I get this question all the time. Hey, I started a company, I formed it in Wyoming or Delaware. I don't have to pay Oregon income tax. It's formed elsewhere. Well, we got to follow the revenue where it's earned, right? So that's an important designation to know there. But it is just liability protection, right? So it's possibly possible to be an LLC and taxed in a variety of ways. So you will at some point potentially need to make a tax election depending on what you're trying to do with that company, okay, from a tax efficient standpoint. All right, so it's actually super important to note. We talk about LLCs. You really got to look at your LLC agreement before you pivot and make an election to another tax entity type, because the language in an LLC is written again for legal state statute purposes, which may differ from taxation purposes, right? So you could have an LLC with language that refers to multiple stock or member units, I should say. And I forgot to mention on the last slide, but an S corporation, you can only have one class of stock, right? So this happens all the time when someone starts an LLC and they go, well, gosh, it's time, let's go S corp. And you go look at the LLC agreement. It's like, well, this is suggesting multiple classes of stock in the LLC. You got to rewrite or amend your agreement. So it's important to know the nuance of what your LLC is saying, all right? Any questions so far? And that's a ton of info. And again, I'm right between you and lunch. So more questions? Yeah, go ahead. In Delaware? Oh, so she's a C corp formed in Delaware, right? I don't know Delaware law specifically. Like Oregon has a excise tax for pleasure of doing business in the state of Oregon. I'm not confident, but it's likely there's something similar in Delaware at some point. You mind like the formation of the entity? You potentially have to pay an excise tax if you're doing business here. Yep, you have 1120 you might file. Yeah, so you might look into that. Okay, anything else? All right, we're good. Let's keep going. Considerations. Let's talk. We talked through these kind of in totality. Let's boil them down and look at them kind of cross-section approach. So from a C corp standpoint, right? Unless we've got a taxpayer-friendly change or dividend taxation, it's generally not desirable, right? For a C corp that's closely held, or a business that's closely held to be a C corp for that double taxation purpose that we talked about, right? The important language here is that we have a taxpayer-friendly change, which those are kind of nuanced as to when they may happen. So we'll see on that. S corporation, right? We talked a little bit about the why you might consider doing that. And at the very least, you want to have enough profit to be able to cover that reasonable salary requirement that you have to take. Okay. LLC, right, allows for more flexibility when deducting losses. This is especially considered, C corp, right, the own entity. Those losses that generate are net operating losses, which just stay in the company and carry forward to offset future profit. Whereas if you've got a partnership LLC or a disregarded LLC, those losses have a direct immediate benefit to offset your current income, whatever those sources might be. So it's important to consider that as well. I should have Perkins Coie for this part, the legal considerations, right? So, yeah, this is a pretty obvious one, though, right? If you're not afraid by a limited personal liability, that doesn't scare you, then a sole proprietor with no legal formation or general partnership might work just fine for you. All right. S corp, C corp, LLC, right? They do have that limited liability as long as the corporate formalities are maintained for the corporation or LLC. Yeah, you could consider a siloed approach to your LLCs, right? Offshooting certain operations of the business, holding companies for different properties and such to further limit liability, depending on what you're doing. All right, well, this is what you're all here for, right? It's the venture angel considerations on this front. We kind of talked through a little bit before, but I just want to make sure it's really clear why this is important. So an angel investor puts money in, and they want that money to grow. They want the business to grow, and they have no intent on needing that money in the immediate term. So they wouldn't want to pay taxes on money they didn't receive, right? So to do that, a C corp is the best route to accomplish that. That's because a partnership and an S corp, you're taxed on the income whether or not you receive it. So if you have a bottom line profit showing of 100,000 and you elect to keep that money in for next year's operations and growth, you're taxed as if you took 100 grand, right? Which is not ideal for your silent investor types. So for that reason, the C corp is likely your best route here. Is this exhausting watching me walk back and forth? I tell you what. All right, so yeah, the good news is you can change your entity type. You can potentially a tax-free exchange. It's called a 351 transfer. You can potentially change in a tax-free event. Make an S corp election, convert to a partnership, or otherwise. There's certain considerations you want to have in doing that, making sure you don't break that transaction. That would be a good time to involve a CPA, ideally before you do said transaction, so we could guide you through that. All right. So some considerations at exit. C Corp's also really nice because there's one level of tax, right? In terms of if you sell stock, you're just selling stock. It's capital gain treatment, just same as you bought and sold stock in Microsoft. So a lot of angel investors and owners like that as well for the easy exit on that front. Okay. Most startups are structured to stock sales, right? And so that's the benefit from that standpoint is you just have capital gains treatment on the sales stock. The original issued C Corp stock, which Perkins-Coie talked about this a little bit, Section 1202 exclusion, right? Based on an entity that was initially set up as a C Corp. That's really important language, right? This happens from time to time where a business gets going and they don't realize what they have and then it takes off and they decide, hey, well, let's go hurry up and be a C Corp so we can exclude some of this gain from income. Unfortunately, it had to be a C Corp at initial formation, right? So that's an important, kind of nuance to be aware of there. Okay. And we've seen that work a couple times. It's actually pretty nice. All right, so let's talk more accounting before we get ready for lunch here, right? So these are really important. It's kind of nuanced considerations in terms of electing your basis, right? In terms of how you're accounting in your books and tax reporting more than anything, right? Cash basis overall, you recognize an income when it's received and you deduct an expense when you pay for it, right? It's obviously like the more simplified version of accounting in general. And you can be that, you can make that initial election. You can be that up to your business of size of 25 million or more. And there's actually, from a tax planning perspective, the cash accounting is like the easiest way to do it, right? Because you run a report, say, hey, what's profit? How much money do we want to spend and knock out the income, right? It's pretty self-explanatory. Accrual accounting gets a little more involved, right? Because you only recognize revenue when you earn it, and you only deduct an expense when you've incurred it. So the easy example of that is if you prepaid for insurance expense in October and you're a calendar year filer, and you're an accrual basis filer, you would deduct in your tax return 2 months worth of the insurance expense because you've now incurred that expense. The other 10 months would just roll over to the next year and they'd be on your books as an asset for prepaid insurance, okay? So there's a little nuance to accrual and it takes away some of the simple planning strategies that are available to a cash basis taxpayer. But at some point, you may be forced to be that. The IRS actually prefers you to be accrual basis. I think it smooths out their collection of revenue and it eliminates some of that ability to kind of manipulate numbers before the end of the year. So just be aware of that. All right, so a couple of costs. A lot of y'all are in the phase where you're incurring a lot of costs for starting up a business, right? And we like to break everything up in accounting and tax law into as many categories as possible, right? And so we got three main ones. They seem largely very similar, right? Organizational costs, startup costs, and operating costs. They're treated quite differently in terms of their reporting and deduction, okay? Organizational costs are amounts paid to create, organize a business entity. And it includes legal service required for organization. It's very important. Necessary accounting services, right? We're very necessary. Expenses of temporary directors and organizational meetings and fees paid to government entities. It does not include the costs of issuing and selling corporate stock. That's not deductible, right? So just be aware of that. Startup costs, similar to organizational costs, but a little bit different. It's basically pre-revenue type of expenditures. Advertising, personnel costs for training, travel, and related expenses. And then startup professional services that are not organizational in nature, okay? It does not include research and development expenses, right? Those are specifically excludable and they are always deductible, right? So good news there. We like to amortize these expenses, right? So you got to carry them out over a period of time, depending on the amount that's incurred, right? Once it's over the balance of $50,000, the amount that's deductible, right, can be up to $5,000 in the current year. Once you hit $50,000, you start amortizing the amount in excess of that, okay? Important to note there. Personal expenditures, this can happen quite a bit, right? Before maybe a business bank account gets established over at US Bank, thank you for being here. You might have an expense you incur personally. That's easy enough to contribute to the business, right? And recognize the deduction for that, okay? IP considerations. I think there's some folks in here. I have a client right now that's going through that process. That's pretty exciting. But same thing, there's differences in how we treat those costs and how we recognize them, depending on if it's a self-developed patent, it's one you bought, right? Off the shelf, if you will, which I don't know what stores selling patents, but apparently they're out there. Okay, so this is kind of neat, right? So research costs are experimental developmental costs, generally all reasonable costs related to the development improvement of a product. I think the bottom line is the most interesting, right? There's a tax court case that they specifically say it does not limit deductions to successful projects nor projects for which success is probable, right? So that's you can have some idea that has no real, inkling that it might be successful, and it's okay to accrue those research costs relative to that, right? You still have to run it in a business manner, but it's important that they know, like, hey, this is hard. You don't have to like prove some level of like this is going to work type of a formula. Usually includes, right, a model, process, formula, invention, technique, or patent in this category. So we talked a little bit about self-created patents, right, and the costs that are wrapped into those, including, where did I go there? Cost paid to stop patent infringement, right? Those are deducted in the current year, whereas other costs would be amortized over the life of that product or the patent, excuse me. Okay, so costs of acquiring a patent or copyright are not as generous as those for creating one. They're going to give you 180 months or 15-year amortizable life, regardless of the legal or useful life of that patent. Okay, important to know that. Yeah, you're generally not going to invest in a company if the patent's not owned, or the IP in general is not owned by that company, right? So it often happens that some level of IP is generated by an owner and starts a company. Ideally, you contribute that at some point for consideration into the company, right? Otherwise, you can have a tough time getting to buy into that, right? Does that make sense? That should make some general sense, right? They want to have some claim on that. I should have updated this slide, I realized, on the research and development costs. Is my mic cutting out a little bit? It's okay. Yeah, we're good. So Section 174, which is research and development costs, I like to think of tax law as social engineering in a way, right? They're trying to incentivize certain behaviors as it relates to a tax deduction or credit. A pretty popular one right now, right, is like clean energy, right? Solar panels, geothermal, electric energy, cars and whatnot. Not too different in the research and development space. They made a change with the Inflation Reduction Act that prioritized domestic research and deduction specifically. And in some ways, they penalized foreign research and development costs. They're now making you amortize domestic costs and above the credit of over a 5-year period, whereas foreign costs is a 15-year period, right? So obviously, the time value of money, $1 today is worth more than $1 tomorrow. So getting those deductions sooner, is a social benefit, if you will, to prioritizing domestic R&D. Okay, so important to note there. And then it's also important to note, right? There's a credit generates when you do the research and development, the deduction credit, right? And we love credits because a credit is a dollar for dollar reduction in tax, which for years, right? If you were a company with losses in the growth phase, you didn't have income tax, right? So it didn't really behoove you to pursue an R&D credit. And they pivoted a few years ago to allow you to have the R&D credit offset payroll taxes, right? Which most people, regardless of what they do, will have some payroll on the books, okay? So important to note, you can still benefit for that even if you don't have income on the books running through. Okay, talked a lot. What do we have?
How about a round of applause for Jordan? You really blew through that.
Golly.
I know, and you made us laugh a couple of times.
Oh.
I'm impressed.
Oh, good.
You're such a pro. All right, so thanks, Jordan. So really great information. Do you have any questions for Jordan? Yes.
If I had expenses for a C corp before the actual entity was formed, what option do I have to either carry those in as losses moving forward, or like, there was something you mentioned briefly about like a loan to the business?
Yeah, this is a great question. So if he had expenses prior to the C corp being formed, what options does he have in terms of carrying those expenses forward?
Perfect. Yeah. So it depends on the nature of the expenses. And if they're pre-operating, right, it would fall into that category of being startup expenses. And then depending on the amount, right, you potentially have a current year deductible amount and some that maybe carry it over as an amortizable deduction, right? You could also have an owner loan relative to the contribution of those expenditures. The big thing on owner loans is to make sure that it's a loan, right? That there's agreed upon terms, there's fair market rate of interest, and terms in terms of the expected repayment of that. But yeah, once you meet those, and yes, you could term it as a loan.
Yeah, I think I'm less interested in having to, sort of pay myself back from the company, and more just can we put that as eventually, essentially an operating expense, even if we are deferring any actual payroll or pre-2024.
Yeah, you can accumulate those expenditures, right? It'd just be startup expenses, right? Up until the point where you like pre-revenue, a lot of those, you kind of saw the chart. I don't know if they send slides out afterwards, but it comes down to what the nature of the expenditure is, right? Is it organizational or is it like pre-operating startup type expenses to get going, and then the contribution that follows suit in terms of its treatment? Yeah.
Have you signed up for office hours? Okay.
Okay. Yeah. Great.
It's for you. Okay. Any other questions?
What's for lunch?
My goodness. Okay. Yes, in the back. So this is a question about the laws regarding reverting from S corp to C corp. Can you revert from back to an LLC?
Yeah, so that rule, which I apologize for not spending more time on, is the built-in gains period, that 5-year period that's mentioned there. And what that is, when you go to an S corp from a C and you have assets that have a built-in gain, there's a 5-year period that if you sell that asset during that period, you're going to pay tax as if you were a C corp. So that's that 5-year period that you're kind of stuck in. We have clients who make S corporation elections, and then for one reason or another revoke those elections. There's no specific rule. It's probably administratively less ideal to make an election revert, kind of constantly switch back and forth. Obviously, at the least, you'd have to wait a calendar year to do so in terms of tax reporting, but there's no restriction on going from an S corp back to an LLC specifically. So yeah, entirely possible.